Hello and welcome to my channel, The Quality Investor. On today's video, I want to discuss the one metric to look at if you can only look at one metric to evaluate when looking to buy high quality stocks. This metric has a high correlation with share price or decline, and it is one metric every investor must understand if you want to find high quality businesses. In my opinion, it explains the majority of why a stock performs the way it performs. One principle I adhere to in life is the Pareto principle, also known as the 80-20. It states that 80% of consequences or the result of an action is affected by only 20% of inputs or causes. And I have found that this principle is applicable to most areas in life. In investing, I posit that 80% of share price movement is affected by this one metric. Suppose then that an investor looks at 5 metrics. This 1 or 20% drives 80% of that outcome. This metric is free cash flow. It is what money is left to the owners of a business after all operational expenses are paid. It is also the basis of the discounted cash flow valuation method. I discuss free cash flow quite a bit on this channel, and I believe it will dictate the results of your investment more than any other metric. When a business's free cash flow is in decline, that business will deliver to shareholders poor returns. A business with compounding free cash flow will deliver compounding and S&P 500 beating returns to the investor. So let's dive into why I believe this is true. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, don't forget to share this video and hit that notification bell so you can know right away when I post more stock analysis content. My investment process is simple. Number 1, identify high quality businesses. Number 2, assess their intrinsic value relative to share price. Number 3, buy when sharply undervalued. And number 4, hold on to it and reap the rewards. The difficult part is step 1, identifying a high quality business. We each have our own definition of high quality. Mine is a business that has the following characteristics. First, the business has predictable streams of revenue. Secondly, a durable economic moat that allows for the growth of that revenue. And thirdly, wisely allocates capital that allows for free cash flow compounding. You see, free cash flow is what capital a business has left to allocate. A business can pay a dividend, buy back its own shares. It can pay down debt, delevering the balance sheet. They can acquire other businesses, or it can reinvest those earnings back into the business to drive organic growth. If a business doesn't have free cash flow or its free cash flow is declining, that means less money to fund future growth. In that case, a business might have to take on debt to spur growth or issue shares, which is dilutive to current shareholders in order to raise cash. The worst case scenario in all of this is that a business can get stuck in a vicious downward spiral if these cash raising strategies fail. Because of this, free cash flow is vital to the future of a business. Remember, markets are forward looking. Businesses that make these wise capital allocation choices ultimately become the free cash flow compounders that we as investors need to spot with our eagle eyes. So how do we know a business is making these wise capital allocation choices that lead to compounding free cash flow? And what does compounding free cash flow even look like? And does all this free cash flow, does it actually drive returns? Well, let's look at some visuals that might answer some of these questions. After going through these visuals, hopefully you'll see how important free cash flow is, not only to the growth of any business, but to those returns that we're really after. So let's start with the first question. How do we know a business is making wise capital decisions that lead to compounding free cash flow? How are we defining this here? How can we quantitatively measure what a business is doing that's driving these results? Well, that's where 2 of my favorite metrics come into play: return on invested capital and return on capital employed. Starting with return on invested capital, ROIC, this is what assesses a company's efficiency in allocating capital to profitable investments. Its basic calculation is by dividing NOPAT, or net operating profit after tax, by invested capital. Invested capital, for the simplicity of this discussion, let's just call it debt plus equity. So we're essentially measuring how much outside investors, either debt investors or equity investors, How much capital are they providing to the business? And what is that business doing to generate after-tax operating income? And that metric is return on invested capital. If a company's operations are returning more than what the cost of that capital, that cost of debt, that cost of equity is, that project is considered profitable. So looking at this top chart here, this is return on invested capital for automatic data processing. And what this chart is telling you is what their ROIC is over the last 10 years, what the average 10-year ROIC is, and then what my threshold is for looking at various investments. So basically, I like to see an ROIC threshold of about 15%. If a company is consistently above that mark, I know that they're doing very good things with capital allocation. And we can see that ADP is definitely doing very good things with that capital allocation. They've never fallen below that 15% mark over the last 10 years. And not only that, you can see it's steadily rising over time. 22.3% in fiscal year of 2013. And today, 11 years later, their ROIC is at a stunning 50% at the end of fiscal year 2023. ADP's core business is providing payroll processing for various businesses of all different sizes. So you can see in this chart here, what they're doing is with the money that they are getting from investors and with their business model, they are generating a lot of operating profit for investors based on their business model. The next metric I'd like to look at, return on capital employed. It's very similar to ROIC, but what this is measuring is a little bit different. So basically, its standard formula is EBIT over capital employed, EBIT being earnings before interest and taxes. However, I like to use Terry Smith's definition of ROCE, which is operating cash over capital employed. I like this definition because I believe operating cash is a far more accurate measure of a company's true income. Cash is cash. Therefore, a lot of the noise surrounding accounting for the income statement side of things is removed when you're looking at just the cash brought into the business. Capital employed is defined as total assets minus current liabilities. This is basically the total equity plus long-term liabilities. Basically, it's a way to quantify how the money is actually being put to use in the business. So again, on this bottom chart here, we're looking at ROCE for automatic data processing. Another way to think about ROCE is how much operating cash per $1 of capital employed is ADP generating. So you can see in fiscal year 2023, they generated 51 cents for every dollar of capital employed. Again, this is, like I said, with ROIC, it's key to look at this trend over time. My threshold here for this is 18%. I like businesses above 18% on a consistent basis. The ROCE 10-year average for ADP is 32%. So they've done very well. Now, 11 years ago in fiscal year 2013, they were at 21 cents per dollar of capital employed for their return. Now they're at 51 cents. So ADP, again, they're doing a very good job with the money that they're using to employ to the business of generating excellent profits. Let's look at some other examples here. Here we're looking at Apple. So the ROIC for Apple and the ROCE for Apple. And you can see that they're also doing a very good job of staying above that threshold I like, as well as increasing it over time. Apple, of course, is famously efficient with their capital. However, this just demonstrates what we really want to see here when we're looking at investments. We just want to see this trend high and increasing over time for both ROIC and ROCE. Here, we're looking at Visa for ROIC and ROCE. And of course, it's not going to be perfect all the time. They're going to dip below at some points. No company is going to have a perfect increasing trend line here. The key is it generally trending upwards over time? And is it generally high over time? And with Visa, that's also a resounding yes. You can see here on the ROCE chart that, yeah, they've dipped down a little bit a couple times, been below that threshold, but over time, they're trending upwards. So what these charts are telling us is how efficiently a business is using the money given it to it by shareholders and other debt investors and generating profits. And when you generate more and more profit, that leads to higher and higher cash returns. And when you have higher and higher cash returns, of course, you have higher free cash flow. And ultimately, this creates that compounding cycle, that positive cycle that we want to see. You generate more income, you have more free cash flow, you invest that in better capital projects, and you generate even more income and more free cash flow. And that cycle continues over time or compounds over time. So what does that ultimately lead to for free cash flow? Well, here is operating cash, CapEx, and free cash flow. Ultimately, what we want to see is this trending higher over time. So you can see for Visa, continuing from our example before, that Visa's operating cash, the gray bar, is steadily increasing over time. The CapEx here, which is subtracted from our operating cash to get the free cash flow, CapEx is basically what they're using to either maintain their current fixed assets or as buying more fixed assets to continue growth in the future. And for Visa, it's a very what they call capital light business, meaning they don't have large capital expenditures in order to maintain their current operations. And that's actually one of the positive things we want in the businesses we're investing. Capital light businesses. So you can see with Visa here that cash flow increasing over time. And because they are very capital light, that free cash flow is increasing over time. And free cash flow, that red bar, this is ultimately what is available to shareholders at the end of the day. It's also what a business uses to make future capital allocation choices that we talked about before. Here, we're looking at an example of what we do not want to see. And this is Walgreens Boots Alliance. You can see that about 5 to 10 years ago, they were doing a pretty good job of increasing their cash. However, since about 2018, they've been declining pretty severely. So a few red flags with Walgreens here is while their cash from operations has been declining, their capital needs to maintain operations has not decreased along with it. That also means their free cash flow has been in decline. A couple of things you can glean from this is that the investments they made in these years did not pay off. I believe it was in fiscal year 16 where Walgreens merged with a European version of Walgreens, Alliance Boots, I believe they were called at the time. And you can see that really has not been additive from a cash flow perspective for Walgreens. These investments have steadily paid less and less a return over time. And Walgreens right now, they're in the midst of closing many, many stores. There's a lot of reasons for this. However, the point is there's less free cash, less red here to reinvest back in the business. And this is going to create a vicious downward cycle for Walgreens. They need cash to pay employees, to pay the dividend, which they cut at the end of fiscal year 23. And they're going to have to get cash from somewhere, either issuing more shares or issuing debt, neither of which is going to be beneficial to shareholders. Okay, so I've talked at length now about how free cash flow is very important to the business and how making wise capital allocation decisions leads to higher free cash flow or compounding free cash flow over time. But does that really correlate with the share price return? I stated at the beginning that I believe free cash flow is about 80% of what's going on in share price return. Is it really that high of a correlation? Well, let's find out. All right, here are 4 charts demonstrating my thesis. And essentially this is the free cash flow versus share price. And this is on a quarterly basis. So the share price is at quarter end for each quarter. And I'm using the trailing 12 free cash flow to remove some of that quarterly noise. But we can see here with ADP, a very high correlation between the share price and free cash flow. All right, how about Fortinet? Well, again, very high correlation. As free cash flow rises over time, so does share price. And what you can see here in early 2021, the share price for Fortinet increased at a much higher rate than the free cash flow. There wasn't that simultaneous increase in free cash flow. And what happened? That share price came back down at the end of 2022 to match what the free cash flow was doing. And then as free cash flow started to go up again, so did the share price. Down here, I show you Walgreens declining free cash flow over time. Well, again, same story. As free cash flow has gone down for Walgreens, so has that share price. An important factor to keep in mind, this is over the long term. In the short term, you're going to have a lot of up and down price movement in a share price. However, over the long term, the share price will ultimately match what the business is providing back to its owners. This is why it's so important to hold on to investments for the long term. There's a lot of noise in the short term, but free cash flow over time drives out that noise. Here's another one, Bloomin' Brands. They're a restaurant company that owns many different restaurants, the most famous brand of which is Outback Steakhouse. And you can see here that even a company with very choppy free cash flow, that share price aligns with it. So over time, Bloomin' Brands has decrease free cash flow, so does the share price. Then they have periods of increasing free cash flow. That price goes up with it. Then it declines again, and then back up, and then back down. So even these very cyclical companies, the share price follows what free cash flow is doing. And to demonstrate that even further, here's Chevron, the giant oil company. Oil, of course, is notoriously cyclical, but you can see as free cash flow goes, so does the share price. And I think this is a good demonstration of that noise I'm talking about. So there's a lot of noise inside of Chevron's share price over the last few years. At the end of the day, it follows what the free cash flow is doing. So if we take anything away from this video today, it's that free cash flow in the long term drives share price. And I think this clearly demonstrates that 80-20 rule. 20% of your inputs will drive 80% of the results. Before we go, I do want to remind you that this is not financial advice. With that, thank you for watching today's video. And what do you think? What kind of metrics do you like to look at? Please let me know in the comments below. Finally, please hit that like button. And if you found this info helpful, subscribe to the channel and join our community. Thank you and happy investing.